We begin tonight with a significant and highly anticipated move from Brussels, targeting the core mechanics of Russia's maritime oil trade. After months of preparation and complex intelligence gathering, the European Union has enacted its most aggressive and specific sanctions package yet against the operational infrastructure supporting Moscow's crude oil exports, what is commonly referred to as the shadow fleet. This new package, the 15th since the full-scale invasion of Ukraine began, moves beyond broad sectoral bans and targets 41 specific, named oil tankers deemed essential to maintaining Russia's high-volume exports outside the Western G7 price cap mechanism. The sanctions are designed not merely to impose an asset freeze, but to functionally incapacitate these vessels by cutting them off from the global ecosystem of essential maritime services. The operational reality over the last 48 hours confirms that this targeted action is already injecting significant friction into Russia's supply chain, though the ultimate severity of the impact remains a central point of contention between Western analysts and official statements emanating from Moscow. Let us first examine what is confirmed based on officially published legal documents and immediate market reactions recorded in the last 2 days. On December 20th, the European Union formally published Regulation 2025 size, legally confirming the new sanctions package. Central to this regulation is the official publication of a detailed list identifying 41 specific oil tankers. This is a critical departure from previous sanctions, which often targeted ownership entities or general sectors. Here, the action is surgical. Each vessel is identified by its official name, its IMO registration number, the unique identifier essential for tracking, and its current or previous flag state, primarily Panama, Liberia, or other unlisted jurisdictions favored by high-risk operations. The majority of the vessels targeted fall into the Suezmax and Aframax categories, standard medium to large crude carriers designed specifically for long-haul shipment. Their removal or incapacitation poses a disproportionate challenge to Russia's ability to maintain high-volume shipments to distant markets in Asia. The mechanism by which these sanctions operate is extremely broad and highly restricted. The sanctions mandate an immediate asset freeze for the listed vessels within any EU jurisdiction. More critically, they prohibit any EU domiciled entity, and this includes subsidiaries operating anywhere in the world, from providing essential services to these ships. The list of prohibited services is the linchpin of this strategy. It encompasses P&I insurance, which is protection and indemnity coverage, the liability shield necessary to enter most international ports. It covers reinsurance, hull classification, technical maintenance, and bunkering, which is the fueling required for transit. Crucially, the prohibition extends to access to EU ports or territorial waters, regardless of whether the crude cargo might ostensibly comply with the G7 price cap. By severing the link to the EU's vast maritime service economy, Brussels is attempting to render these 41 vessels functionally uninsurable and unserviceable under standard global conditions. To ensure enforcement, the sanctions also targeted 11 specific maritime management firms, mostly based in jurisdictions like the UAE, Turkey, and Singapore, which were identified as operating these opaque ownership structures linked directly to the sanctioned tankers. This multi-layered approach aims to prevent simple paper shuffling from circumventing the intent of the regulation. The immediate reaction from the global insurance sector underscores the potency of the action. The International Group of P&I Clubs, or EAGPI, the collective body that underwrites the vast majority of global maritime liability, confirmed within hours of the announcement that all member clubs have issued formal notices of insurance withdrawal to the listed vessels and the associated management companies effective immediately. Without P&I coverage, the operational risk to any receiving port or terminal becomes untenable. We have already seen measurable operational data reflecting this new friction. Trading data showed an immediate and noticeable widening of the discount for seaborne Russian Urals crude. In the 24 hours following the announcement, the risk premium associated with buying and transporting this crude increased sharply. The Urals price cap exemption price fell by approximately $2.50 per barrel relative to the global Brent benchmark. This movement reflects immediate buyer uncertainty and the pricing in of higher logistical and insurance risk. Furthermore, confirmed shipping databases, including those monitored by global intelligence firms, report an immediate operational headache at critical maritime choke points. There has been a surge in vessel identification requests submitted by coastal state authorities, particularly those in key transit regions such as Turkey, Greece, and Gibraltar, targeting the newly sanctioned IMO numbers. This mandatory screening and heightened scrutiny by port and transit authorities has resulted in documented congestion and delays. Verified data shows that known high-risk vessels passing through the crucial Turkish Straits are now experiencing measurable delays, averaging 60 hours. This sudden bottleneck demonstrates that the physical enforcement mechanism is already slowing the pace of oil reaching the market. Now, we must shift our focus to the battlefield of claims and counterclaims, the assertions and projections that, while highly relevant, are not yet independently verifiable. Moscow's official response has been one of dismissal and confidence. A spokesperson for the Russian Ministry of Energy, speaking yesterday, claimed that the sanctions would have minimal to zero impact on their export volumes. The argument put forth is twofold. First, they assert that the 41 targeted vessels represent less than 6% of the total operational capacity necessary to maintain exports. Second, and perhaps more importantly, the spokesperson asserted that Russia's national reinsurance company, or RNRC, has already fully absorbed the associated reinsurance risks for these vessels. This claim regarding RNRC capability is the cornerstone of Russia's argument for resilience. However, Western experts note that while RNRC can issue paper coverage, the practical enforceability and acceptance of RNRC policies by international ports, terminals, and banking institutions remain highly questionable, especially when pitted against formal EU sanctions that include asset freeze provisions. The key challenge for Moscow is translating a domestic reinsurance policy into globally accepted liability coverage. It is also claimed that Russia possesses immediate, non-sanctioned replacement tonnage ready to step into the operational gap. Unnamed industry sources have suggested that as many as 20 replacement vessels, representing several million deadweight tons of capacity, have been recently purchased or renamed in the final quarter of this year and are already staged for deployment near the Atlantic transshipment hubs. While the purchase and renaming of ships is a verified strategy employed by Russia over the last 2 years, independent verification of the immediate operational readiness, the condition of these vessels, and the true legal ownership trail is impossible without audited records and confirmation of vessel inspections. These claims, therefore, remain highly speculative assertions of intent. Adding to the complexity is the immediate effort to evade identification. Shipping analysts claim that at least 15 of the 41 sanctioned vessels are already attempting or finalizing flag state deregistration and re-registration procedures. The common goal is to move to jurisdictions with notoriously lax regulatory oversight, with specific mention of registries in regions like the Comoros Islands or unnamed African registries, specifically to complicate tracking systems and enforcement efforts. While the filing attempts may be real, flag changes are not instantaneous and can take several weeks to confirm, meaning these movements are currently speculative based on observed filing attempts rather than confirmed completions. On the Western side, analysts are painting a far graver picture regarding the potential impact on Moscow's revenue stream. Leading maritime analytics firms estimate that the importance of the 41 vessels is being understated by Russian officials. These firms argue that the targeted ships represent approximately 12 to 15% of the total current export capacity, operating entirely outside the G7 price cap mechanism. This distinction is vital. These are not merely a random set of vessels, but rather the hard-to-replace, high-risk segment of the fleet necessary to move maximum volumes at maximum profit, which means their removal poses serious operational difficulties and will significantly increase freight costs. Based on this projection of operational difficulty, several major financial institutions, including large global banks, have issued notes outlining potential consequences. These notes claim that, assuming a conservative 50% operational incapacitation rate for the sanctioned vessels, Russia may be forced to cut its actual oil output or exports by a margin ranging from 250,000 to 300,000 barrels per day, beginning in January of next year. It is crucial to remember that this figure is a forward-looking projection based on a modeled scenario of vessel disruption, not on current confirmed lifting rates. Should Moscow successfully deploy replacement vessels quickly, this projected cut could be mitigated. Furthermore, shipbrokers are reporting extreme volatility in the spot market for maritime shipping. It is claimed that freight rates for non-sanctioned, non-Russian-linked tankers operating in key areas like the Baltic and Black Seas have spiked by over 40% in the past 48 hours. This increase is attributed to a dual effect: the immediate reduction of overall compliant capacity combined with a heightened risk premium for any vessel operating near these sanctioned areas. This dramatic reported spot market volatility will require sustained confirmation over the coming week to determine if it is a temporary market shock or a lasting structural change in shipping costs. To understand the full geopolitical context, we must recognize that these sanctions signal a shift in strategy. Earlier sanctions relied on bureaucratic complexity and secondary restrictions. The new EU action is a direct assault on the logistics of the shadow fleet, the very structure Russia developed to nullify previous Western restrictions. The shadow fleet emerged as a direct response to the G7 price cap introduced in late 2022. That cap allows Western services to be used only if the oil is sold below a fixed price. To sell above the cap, Russia rapidly acquired a fleet of older, often poorly maintained vessels, operating outside Western insurance and regulatory frameworks. The success of this fleet has allowed Russia to maintain robust export revenues despite the war. The EU's move now aims to increase the operating cost, the safety risk, and the compliance burden on this very fleet, essentially forcing Moscow to choose between lower export revenues or massive, high-risk investment in replacement vessels. Historically, sanctions targeting specific vessels and their associated service providers have been challenging to enforce due to the ease with which vessels can change flag states, names, and even ownership shell corporations. However, the current action leverages the undeniable reality that modern global shipping depends heavily on certain fixed choke points: the Turkish Straits, the Suez Canal, Gibraltar. And these choke points are overseen by states increasingly sensitive to compliance with major international regulations, particularly those that carry potential liability risks like the immediate withdrawal of P&I coverage. The confirmed delays we see in the Turkish Straits suggest this enforcement mechanism is already having an effect. The credibility of Russia's claims of swift replacement hinges on two primary factors: the state of the replacement vessels and the reliability of R&RC. Many vessels utilized in the shadow fleet are past their typical service life. Introducing dozens of similarly aged vessels rapidly into operational service carries substantial safety and environmental risks, risks that may be acceptable to Moscow but will surely concern receiving states in Asia, who must weigh the revenue from cheap oil against potential catastrophic environmental liability from a ship accident, lacking verifiable international insurance. The next few weeks will be critical in assessing the true efficacy of the 15th sanctions package. Our watch list for verification includes several key indicators. First, we must track the actual manifest data for Russian seaborne exports. If the Goldman Sachs and JP Morgan projections are correct, we should see measurable dips in total volume lifted from Baltic and Black Sea ports in January.